If the yield curve uninverts because the long end goes up, that is called a bear steepener. And that would normally be good news for the economy. But if it's a bear steepener, it means that investors are losing confidence in our treasuries.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Michael Pento, president and founder of Pento Portfolio Strategies, joins us today. Michael has more than 30 years of professional investment experience, and he has worked on the floor of the New York Stock Exchange during the mid 90s. And he has served as an economist for both Delta Global and Euro Pacific Capital. He was also the portfolio creator and consultant to Delta Claymore's commodity portfolios, which were distributed through Claymore Guggenheim's sales network. And we're delighted to have Michael join us here today. It's time to saddle up and silver up for Michael Pento. Michael, welcome back to SBTV. How are you doing?
Always good to be on with you, Patrick. I'm doing fine.
All right, glad that you're doing fine. I'm really happy to have you back. Um, I want to start off with the bond yields and what's going on with them. I mean, it's been inverted. It's been pretty volatile as of late. So for let's say maybe the past year or so, as you've been watching all of these things unfold in the bond market, what has been your sentiment with the bond market and what's going on and where it's heading?
Well, that's the whole show right there. Because let's try to surmise where we are right now. So at Pentaport, we sold all of our long duration bonds on August 1st. We had a very small portion of the portfolio, about 5 or 6% in the TLT, which is a 20-year plus duration it's part of the portfolio. But we've had anywhere from 50 to 75% of the portfolio in short duration bonds, short duration treasuries like T-bills. And really, you get a higher yield there because the yield curve is inverted still. The yield curve was inverted by over 100 basis points. It's now uninverting to the point where it's now about 25 basis points of inversion. But remember, the yield curve has been inverted for a very, very long time. And it's been inverted much more than it was even heading into the aughts, so the great financial crisis, 2006, 2008, and the real estate debacle. So the yield curve is still inverted. How it inverts is very, very important. So in other words, if the yield curve uninverts, I'm sorry I have to get into the weeds here, so let's just do it. If the yield curve uninverts by the short end coming down in yield, that's a sign of the economy healing as we enter into the teeth of the depression or recession. So people are buying short-term bonds. They're trying to front run the Fed because the Fed controls the money markets. That's short-term rates. The Fed will be cutting rates drastically, so that uninverts the yield curve, right? Short end goes down, long end comes down a little bit, but not as fast and as hard as the short end. The yield curve uninverts. Borrowing costs are coming down. It's a healing process. It's part of the healing process. It's a time where you should have been out of stocks. You should have been short stocks. You should be long the 4 horsemen of the economic apocalypse. So we can get into that later. And you're looking now to cover your shorts and to go long equities. If the yield curve uninverts because the long end goes up, so yield curve is inverted, so the short end is higher, the long end is lower, right? And it uninverts not because the short end comes down, it's because the long end comes up, which is what's happening today. That is called a bear steepener. Not to confuse you with more language, but Wall Street loves to, bull steepeners, bear steepeners. That's called a bear steepener. And that would normally be good news for the economy because a steep yield curve is good for the economy. But if it's a bear steepener, it means that investors are losing confidence in this particular context. And I've been doing this 32 years. I'll tell you what it means. This is the truth. It means that investors are losing confidence in our treasuries, in the market for US debt. And there's a good reason for that. Total publicly traded debt has surged from $17.1 trillion at the start of 2020, which wasn't too long ago, Patrick, right?
Yeah.
To $26.5 trillion today. So from 17 trillion to 26 trillion. Now that's publicly traded debt. That's a debt that's actually floated out there that needs to be owned by the public. That doesn't include intragovernmental debt. That puts us at $33.6 trillion. But that's not traded. That's like IOUs and for Social Security, Medicare. Nobody cares about that. All right. I care about that, but the bond market cares about what debt needs to be purchased by the free market. Whatever's left of the free market outside the Fed. Remember, the Fed's doing QT now, so the Fed's out of the picture. Actually adding to that supply. 17 to $26 trillion. That's a tremendous supply. And the interest that we pay on that debt has doubled from around 1.5% to 3% over that same time period. So we're already paying $712 billion on interest, which is the third. You have Social Security, Medicare, Medicaid, and then you have defense. Those are the big budget items. Okay, interest on the debt is going to be higher than defense spending. It should be about $1.5 trillion as these bonds roll over, and instead of paying 3%, you're paying 5% on the debt. That's where the yield curve is right now, 5%. So anyway, back to the yield curve. Long answer. I told you I could do a whole show on this. So yield curves uninverting, right? But it's bad news because that means, again, investors are losing faith in our bond market. It's because there's just a tremendous supply out there that's being generated, and all of the buyers are gone. Where have they all gone, Patrick? Well, let's see. The Fed is a seller now, not a buyer. QE is over and QT is in place. Japan is reducing their exposure to treasuries, and they're doing so to protect their currency. They are also relaxing yield curve control, which is more competition for treasuries. China is doing the same thing with its currency. By the way, I'll add in this. The Atlanta Fed has GDP growth at 5.4%. And inflation has gone from 9 to 3, which is good news, but now it's back to 3.7, closer to 4%. So you have reflation. So if you have reflation, if you have nominal GDP at 9%, and you have no buyers and the supply is overwhelming, guess what? You've got a big bond market problem, Patrick. And I'll just wrap this up with one more point. Hate to take the whole show in one question.
No, I'm fine. I'm fine.
When you have people say, well, there isn't any problem out there. There's no leverage in the system. Remember, they said, the consumers deleverage, the corporations flush with cash, and there's no leverage in the system. Well, I just told you that the leverage in the system went from $17 trillion to $26 trillion in the space of a couple of years. And guess what? The government doesn't have any money, Patrick. They come to us for the money. And when they come to us for the money to fund the deficits, it's just like the same as public. It's the same as private sector debt. There's no difference, really. Well, the public has deleveraged. They went from 100% debt to GDP to 73% debt to GDP. Well, that's good. It's still much higher than it was in 2020, but it's still the right direction. But corporations have a record amount of debt to GDP, and the government has a record amount of debt to GDP. And they're losing control of the bond market. And it matters because the free market says the government is insolvent and we need to get paid a whole lot more to own your debt.
If you're enjoying this interview with Michael Pento and I, please consider subscribing to our YouTube channel. And be sure to send me an email, patrick@silverbullion.com.sg, with email me in the subject heading so I can better stay in touch with you and let you know when new content is posted, new products, new promos, and new original articles and insights, all to help you truly secure their wealth. Mike, I just want to unpack a couple of things because you said Jerome Powell, he's doing QT, he's trying to tighten up a bit. But at the same time, we have Yellen who's looking to fund wars here and there and whatever else. And so, I mean, it's kind of like we have the Treasury wanting to issue out more bonds, and then we have Powell looking to tighten. I mean, and I think Yellen even wants to have some kind of yield curve control going on. But isn't that the central bank's job instead of the Treasury's job?
Well, Janet Yellen was, head of the Fed not too long ago.
Right.
Supposed to be a wall between Treasury and the Fed, but that's all BS. You know what happened in COVID? COVID broke out. What did they do? Well, Yellen and Powell were best buds. They said, okay,
Yeah.
we're going to issue $6 trillion in COVID stimulus. This is what they did. The Treasury did that. Checks to consumers, loan forgiveness, forbearance. Even Biden right now still wants to forgive student loans, adding to the debt. And the Fed says, okay, Janet, you're going to do that. I'm going to do the helicopter money. I'm going to monetize all of it, and I'm going to print $4.5 trillion. That's what the Fed did. They expanded base money supply by $4.5 trillion. And the banks did the rest. So, yeah, it's an unholy union between the Fed and the Treasury. But as of right now, that's not happening. I mean, they had so deficits were $2 trillion, the fiscal deficit for fiscal 2023, $2 trillion. During recessions, the deficit usually goes up by so it was 200%. So you're going to have deficits of $6 trillion the next time we have a recession. And right now, the Fed is not buying; they're selling. And if you want to get a little bit more into the weeds, you have to get in the weeds if you want to get things right. So there's something called the reverse repo facility.
Mm.
Well, that happened to have $2.23 trillion in it not too long ago. Now that reverse repo facility is $1.1 trillion and going down. So what I'm trying to say, well, why would you mention that, Mr. Pento? Because $1.1 trillion in the reverse repo facility, this is where the banks have parked their excess reserves at the Fed. Okay? It's fallow, high-powered money. It's off out of the banking system. It's just they're earning interest. It's out of the economy. But the Fed is doing QT, so it's draining reserves from the system. But those reserves are coming from the reverse repo facility. So it's one hand money going out of one pocket, coming in the other pocket of the Fed. But that ends in around March of 24. The reverse repo facility should be at its current pace of decline close to zero. So the banks won't have any more excess reserves. And that's when you're going to get a repo crisis, credit crisis. And that's a big problem for the Fed, because the Fed's going to have to come back in and reliquify the bond market, because you can't have an economy if you can't float commercial paper, if you can't float a junk bond, and if the Treasury doesn't have any money to support their borrowing, guess what? The economy ceases up. It's like an engine without oil. And so the Fed's not going to be worried about anything else but getting the credit markets, the money markets functioning again, which means they're going to go back to QE and lower interest rates, but they're going to be doing so when the inflation rate is way above their target. And what that says about the solvency of the country, about the ability of the Fed to provide a real interest rate for savers, I mean, it's going to speak loudly. The answer is no. He's not going to. The Federal Reserve will never again be able to fool any investor that they can provide a real interest rate for savers. That's over. And that has big ramifications for a lot of things, a lot of asset classes. So what do you want to own treasuries? If you do, where do you want to buy them on the curve? Do you want to short treasuries? That's what I'll be doing when that's the case. Do you want to own bond and bond proxies and equities, or do you want to have a stagflationary hedge to the portfolio? I will have a stagflationary hedge to the portfolio. Listen, Patrick, the 60-40 portfolio is dead and buried. Let me just talk about that for a second, if you don't mind. Good question. I'm glad you asked it. So
Sure, yeah.
if you, this is what kills me. I mean, people are, trapped in this sort of Wall Street, I call it the deep state of Wall Street paradigm of a 60-40 portfolio. And of course, that's 60% stocks, 40% bonds. It varies depending on your age, but you get the general idea. But if let's just go back to 2020, if you bought the long duration bonds, so if you bought extended duration bonds or if you bought TLT, 20-year bonds, you're down anywhere between 45 and 60%. Now, again, you bought the safest asset on the planet Earth, supposedly, which is a long-term U.S. Treasury bond. Mm-hmm. And the result was that you lost between 45 and 60%, depending on how far out the curve you went. If you went just over 20 years, you lost 45. If you went in extended duration, like zero coupon bonds, you lost 65% of your portfolio of your wealth in bonds. That's something that only happens in crashes in, like, pink sheet stocks, or like the NASDAQ debacle, or the Great Recession. You lost that in treasuries. And you say, well, Mr. Pento, but isn't the stock market doing pretty good this year? Well, no, the average stock is down this year. And if you go back to the peak of the bull market, which was the end of 2021, the NASDAQ, inclusive of AI stocks, is down 13%. So what I'm saying is that the 60-40 portfolio is dead and buried. You just can't own it anymore. And you have to be an active manager. You have to know what asset classes to own, what sectors, what style factors, and where do you want to invest your bond portfolio, if any. If any, we are in the short end of the curve, just earning that higher yield with little to no risk, or much less risk. But if you're that 60-40 portfolio guy or gal, and your 40% of your bonds is, half long duration and half T-bills, you've gotten killed. That's supposed to be the ballast in your portfolio. That's supposed to offset the 2-year decline in your stock portfolio, and it's actually done much worse.
We saw the repo market explode, and it kind of tapered off, and then we saw the reverse repo market really start to move, and now we're seeing that kind of start to trim down a bit. So you're saying it's just going to end up going back into the repo market? Then we're going to see that start to move up again?
The reverse repo facility is where the banks park their excess reserves. Right. And those are the excess reserves that were generated from COVID. Those reserves are dwindling quickly as the Fed is draining money supply through its QT program. Once those reserves are gone, then if the QT program were to continue, and don't forget, we went from $4.5 trillion in the base money supply to $9 trillion of the base money supply because of COVID, because of what Powell did in response to shutting down the economy. You still have a lot of excess reserves in the system. So the Fed wants to drain those excess reserves from the system, or that base money supply. But the excess reserves should be gone by March, according to what I see in the reverse repo facility. So the banks will still have some excess reserves, but they won't be anything close to what they have or what they had just a few months ago. Remember, the high was about a year ago. It was about $2.3 trillion. Right. So then if the Fed's QT program continues, which is burning base money supply, right, trying to get back towards maybe $6 trillion, it's just going to be pure draining of reserves from the system. It won't be that they have the banks won't have those excess reserves sitting in the reverse repo facility. So when that goes dry, you'll have generated increased, not decreased, increased bond market chaos, because the liquidity, which is already almost evaporated, will be completely gone, or virtually completely gone. And then I'm get to your question is, then the Fed has a conundrum. What do they do? Well, they have no choice. They have to reliquify the bond market and the money markets by lowering interest rates and going back into QE. That's what they're going to do. But they're going to be doing it, again, from not from a situation where, oh my gosh, I can't get to 2% inflation like they were, after the Great Recession for many, many years. They're going to be doing it they're going to be doing it. In other words, it being pursuing inflation when inflation is just off, not too long ago it was 9%. Now it's back to close to 4, but they're going to start their inflation quest from 4.
Mhm.
And what is the terminal rate of inflation when the bond market's going to understand that it can't operate without continuous QE? If the bond market can't operate without continuous QE and interest rate suppression, real interest rates are going to be profoundly negative, and that has a massive implication for base metals, energy, and gold.
Right. Okay. I'll get back to that one, but I need to backtrack a little bit. You mentioned the 4 economic horsemen. What are those?
So you have cash, you put that under your mattress, or that doesn't get hurt in the economic apocalypse. There's the 4 horsemen of the economic apocalypse is what you need to own, and you always need to own these 4 things when you have a debacle in the economy. So you have some cash. You also have short-term treasuries. You get 0 duration, so the principal can't go down, but you have a nice juicy yield. Those don't get hurt. You might want to go a little bit out on the yield curve as well, because the principal will definitely appreciate as those yields come down. Again, it'll be a truncated period of time because on the other end of that, we know it's coming. So yields will come down. So you want to grab that principal appreciation. You want to own the US dollar, not against gold, Patrick, against the euro. I mean, one of our biggest positions has been over the years, 2 years now running, is the US dollar. This is from someone who understands that the US dollar is losing its hegemony. It's losing its world reserve currency status. I get it. It's being destroyed against real estate. It's losing its value against gold, but not against the euro. So I'm long the gold vis-a-vis other flawed fiat currencies like the euro and the yen. Been a tremendous benefit for us. Long the dollar. And the other leg of that 4-pronged stool is shorts. You have to be able to short the market and do it adroitly. So you can't just buy something and hold it, especially if you do inverse ETFs. You buy them and you close out the short. So you buy back. What I do is I use ETFs because I don't use margin or leverage because I have a lot of retirement money in my portfolio of clients. So I go long ETFs, inverse ETFs, and other straight short ETFs, and I'll cover those shorts when I need to and play those swings because you have to. Otherwise, you won't make any money just holding a basket of inverse ETFs through the duration of time of a 1 or 2 year bear market. And if you do those 4 things, if you own cash and you own bonds, you own the dollar, and you own shorts and do it correctly, you should and could make money in the coming debacle. And I say the coming debacle, bonds will work well because you had that. I mean, when you talk about bonds, let's just say the TLT, which is a 20-year plus bond, you have to make 80% in that to break even. 80%. So just to get back to where you were when this bear market and bonds started, I mean, that's a lot of money you can make. I'm not sure you're going to make 80%, but if you can make close to that, 50%, owning a US Treasury bond, when the market is crashing, that wasn't available in 2020. In the 2020 bear market or 2022 bear market, just wasn't available because the interest rates were too low, much higher than they were in 2020 and especially 2022. And if you can make money in the US dollar, you can make money in shorts, then you can make money while the stock market is crashing. And I say crashing because it's important to understand that the total market cap of equities as a percentage of GDP. So that's the best metric. It's Warren Buffett's favorite. It's my favorite metric. Not that I'm making myself a Warren Buffett, but it is my favorite, and it is his. It's the best valuation metric for the stock market. And if that valuation is higher today than market cap of equities as a percentage of GDP, is higher today than at any other time in history prior to the outbreak of COVID. That shows you how overvalued the stock market is and how far it has to fall. And it will fall in the next recession. And the next recession is coming. I have a process, I have a timing tool, I have the inflation, deflation, economic cycle model tool that has kept me from being overly bearish up until now. But I'm ready and I'm waiting for a couple of things to fall into place, like the spread between high yield treasuries, high yield junk bonds and treasuries, and credit spreads and financial conditions. When those things move in the direction I think they're going to move, I will start putting on straight shorts into the portfolio as well as going out on duration. And that should be a winning portfolio. You have to be very adroit and you have to be very nimble in this market. You just buy and hold just doesn't work. Think about alternatives too.
Okay. Michael, we often hear the term that there could be a bond market collapse. Um, what's your opinion on that? And let's say for people who may not have any bonds, but maybe they have some gold, some silver. Uh, how does it look for them, the people that don't hold bonds, and say there is a type of a bond market collapse?
The EDV, the extended duration, and that's what is clear. The EDV is down. You have to make up 150%. So it's down 60%, 65%, something like that. You have to make 150% to break out to be even in the EDV. So if your extended duration bonds, your zero coupon bonds, are down 65%, 60 to 65%, that's a bond crash. You've already had your bond market crash. You've already had a massive bond market crash in extended duration bonds. Don't forget, these bonds were zero. They were yielding zero in 2022. And now they're yielding, 5%, close to 5%. That's a crash. It's an absolute complete crash in the bond market. I don't think you've seen the worst of it yet, though. And that's why you have to be nimble. So let me explain. There's going to be a small window once the recession begins to manifest to buy these bonds. So principal goes up, the yield comes back down a little bit. And then on the other end of that, as I stated before, there's going to be a period of stagflation in this country that we have never before imagined, in my opinion. And precisely because the Fed will telegraph to everybody. I mean, they will, through inculcation, have taught investors, we, as an institution, cannot ever raise interest rates to a level that can adequately vanquish inflation. We must do QE perpetually and engage in bond market repression of yields in order for the markets to function. And that means everything that the Fed is not actively engaged in buying is going to explode in yield and crash in price. So think about junk bonds and corporate bonds, municipal bonds. If they're not buying them, inflation is going to run amok and those yields are going to skyrocket. So I don't think you've seen the worst on that front yet.
I guess I just got asked, how did we get here? I mean, some people want to say trade wars, tariffs, dollar weaponization, removing gold from being money or backing money. Others may say, when mom had to leave to go to work to help out with inflation and left the children home with no supervision, discipline, and things like. I mean, a lot of things. But in your opinion, where do you think maybe the one or two places that can point us back to when these things happen, it put us on the path of where we are today?
Oh, well, I can answer that in twofold. For economically speaking, 1987, the crash of 87, Greenspan then engaged in a process of papering over every stock market decline. So whenever you had a problem, 87, 98, which was long-term capital, 2000 NASDAQ collapse, 2008 real estate debacle, great global financial crisis, 2018 repo crisis, and the 2020 COVID crisis, and the 2022 banking crisis in March when he launched the BTFP, Bank Term Funding Program. It's become habitual now that the Fed says, hey, we have a tool here. We have a tool called fiat money. We'll just print all we can whenever we have a problem. So if there's a recession, print money. If there's a downtick in the stock market, we'll print money. And this is now markets becomes, I mean, we got to the point in 2022 when the yield across the board on treasuries was close to zero. That's how bad things became. And of course, when when money is free, people borrow it, and you have over-leveraged consumers, over-leveraged businesses, and most of all, an over-leveraged government. That's economically speaking. But then you also intimated about mom going to work. I think when we removed God from the schools and from our families, we fracture. If you want to destroy a country, you destroy the family, and the way you destroy a family is to take God out of the picture. So, and you have those two things happening around the same time, and this is the result. This is what you get.
All right, amen to that. Michael, before we wrap up, can you tell us how to follow you on social media and, of course, the service you provide at Pento Port?
So I have a website. It's pentoport.com. You can go on the website there and you could register for a free trial. It's a 5-week trial of something called the midweek reality check, which I give you the salient data points that I think are worth noting. It's $50 a year after that. That's all. If you have around $100,000 to invest and you're a U.S. citizen, I will manage your money personally. And in this way, hopefully you can make money. The goal is to make money in bear markets and to make money in bull markets, and to identify where you are so you don't suffer the 50, 40, 50% drawdowns that destroy your retirement plans. This is paramount, a paramount thing that we seek to avoid, and we've never have, and God willing, we never will come anything close to losing that kind of money. So the phone number here is 732-772-9500, and you can email me directly at mpento@pentoport.com.
All right, we'll be sure to put that out. Michael Pento, I appreciate the time you've given. I think you've laid out a pretty solid path for people to really have that type of a barbell approach where they're okay on this side, then they'll travel through and they'll be okay on that side. So I think you laid it out pretty well. So I thank you for that.
You're welcome. I mean, it's going to be very choppy, very dynamic. But the point I want to make is that just buying and holding a bunch of stocks and bonds doesn't work any longer, because markets have become dysfunctional, and they've become dysfunctional because they've been massively and comprehensively manipulated.
Yeah, couldn't agree more. All right, thanks again, Michael. That was Michael Pento sharing his views on the economy and gold and silver. To see more of Michael's work, please go to pentoport.com. If you like this video, please do subscribe, share it, and give us a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.